Live right now. Ready?
The passive investor.
Welcome back. This is Walter Amarillo with the Alchemist Nation podcast. This is a real estate podcast where we talk to some very successful people all across the nation about multifamily investment. Although we do talk about single families, you know that's not where our heart is. We're talking about multifamilies, how we can build. I think that's where the future is. And so we want to continue focusing this podcast on people who are extremely successful, care about building their empires, and are here to actually give back to you and teach you a little bit. Today I'm with Seshadri. Did I pronounce that right, Sandhya?
Yeah, I'm glad to be here. Thank you for having me on your show.
Very good. Thank you. So we were just talking about fees. We were just talking about your passion around why it doesn't make sense to take all the money from the investors up front, even though they put all their money in, and then you walk away and they are stuck for 5 years waiting for their return. But the other investor who's raised the capital has actually gotten their money right up front. What does that mean to an investor? Why do you care so much where other syndicators seem to just not have that as an issue? In fact, it's very controversial in the community.
We are talking about acquisition fees. These are the fees that are paid upfront to the sponsorship team as soon as the deal is closed, well before they start executing the business plan and returning money to the investors. Now, the acquisition fee has several parts to it. So certainly, if someone acquired a property off market and they have to pay the broker a fee, that's part of the acquisition fee. So I'm okay with whatever that portion is. But when the acquisition fee portion that goes exclusively to the sponsors is something like 3 or 4% kind of number on a $50 million deal, well, right. I know for a fact that the sponsors have no money left in the deal as investors themselves. And a lot of them advertise, oh, we are the sponsorship team, have so much skin in the game. Well, how much skin in the game do you have after acquisition and after closing this deal when you begin to execute the business plan? And for me, my rule is that the sponsorship team, every one of the sponsors, still has at least the minimum investment, 50K, 75K, whatever it is. The sponsorship team, each one of them should have at least the minimum amount invested in the deal after closing, so that, let's say the deal goes poorly, the deal goes really badly for whatever reason. It could be beyond their control as well, like eviction moratorium kind of situations. Well, the passive investor isn't the only one who should be sort of losing their money or at risk for the money. The risk should be shared as much by the sponsor. That's what I'm saying. So if the sponsor is so confident of their deal, please put your money where your mouth is. You know, if you're so confident that this deal is going to do fantastically well, you're going to double my money and triple my money in a short amount of time, that's fantastic. Please reward yourself at the end with a waterfall structure. Just say, hey, I've doubled your money in 5 years or whatever that might be. I'm going to now take the split down to a 50-50 from a 70-30 or whatever your number is. And that's fine with me. So again, my question is, when the portion of the acquisition fee that exclusively goes to the sponsorship team exceeds the minimum amount of investment in the deal, and therefore after closing the sponsors have no skin in the game, I have a problem with that. And that's my personal preference for passive investing. And I follow that rule. When I have a deal to pitch to my passive investors, you know for sure that I'm going to have more than the minimum invested in the deal because I believe in it. That's why I'm in the deal, guaranteeing my name on a loan, et cetera, et cetera.
I love your energy. I love your philosophy already. So we had like 30 seconds before this call, and I got to learn just a little bit about this concept, and you just executed that perfectly. Like, I already feel confident that you're in this with me. So if I drop 50,000 into this deal, whatever this deal may be, you're in it with me. And if something went sideways, I know you're suffering as much as I am. Before we dive more into the fee structure and how syndication works, I'd like to go back to earlier, Sandhya, before you got into real estate. What got you into this? What did you do before you got into real estate? Before you're the queen of syndications and doing this the right way?
So my background is in electrical engineering. I have a bachelor's and master's in electrical engineering, and I also have an MBA. So I had the corporate career, after which once I had children and family became a bigger priority, I went completely into the stock market, and I did fine in the stock market. And I think a lot of it was luck. The stock market did well for all of us for a while. And so after that, I was paying more in taxes, and every rich person I knew always had something to do with real estate. So I wanted to get into it. But single family was scary to me because I just didn't like the idea of a second mortgage on a property and having to take care of tenants to screen them properly and to have to self manage. I just didn't see the margins to justify the amount I had to put into it to make a few $100 a month. So when a person told me about multifamily and the fact that you can afford third party property management, and to where I have my own time, I just look at reports weekly and pay a lot of attention up front at the beginning of the project, but once it's stabilized, it flows pretty well. That's what got me into multifamily. And I'm based in Dallas. I've lived here for over 30 years, so it seems to be quite a big hub for multifamily. So I joined a mentoring group that is based here and is very well established here in Dallas, and that's what really helped me take off. I found hundreds of like-minded people in a network there where I could collaborate, talk about vendors, talk about property management, etc. And this network is what really helped me launch
Wow.
my
You just
third
opened up
career.
so many avenues here. So one, networking is so powerful. Getting
Mhm.
into a great community, a mastermind, a coaching program where you're going to be with those higher level people doing the things you want to do. Dallas, right? Great economy, a great market for multifamily.
Yeah.
They have a lot. They just have a lot of
Yeah.
inventory, and it makes it really easy to expand there. Although obviously it's becoming more competitive. But the fact that you're in that market, I want to come visit. So it may not be this year once COVID lightens up a little bit. I'm moving to the Tampa market, but I love the Dallas Fort Worth area. Like that's one of the investment markets I'm interested in.
Yes.
So you started off, you didn't do any single families, right? Maybe you had your own single, but you said I'm going right into multifamily
Mhm.
because you just didn't have time for anything else. It just didn't make sense to you.
The numbers don't make sense. I'm a very number driven person. And so for me to, buy a 150K home and make $300-400 a month on it, I don't want to spend my time trying to flip it, etc. There's a lot of people who are really good at it, who make a lot of money, but I don't have a construction background. I didn't grow up with a dad who does all, handyman kind of stuff and learn that and just know it anyway. All I knew was analysis, numbers, spreadsheets, those talk to me. So underwriting deals is great. And being in Dallas, I can get to drive every property. I know my little neighborhoods. I know places that were empty fields that have become huge new cities now, et cetera. So it's really important to know your market when you get into investments, whether you're doing it passively or actively. Knowledge of the market really gives you a one up on everybody else. Like even within a particular city, I can tell you which side of the city is a good place versus which one has more of the high crime. And just because it's like right down the street from downtown Dallas, that's not necessarily a safe place for properties. So I don't like to invest in high crime areas passively or actively. So I just have a very narrow criteria, but I know exactly as soon as I look at a listing, I know, okay, that's worth looking into or pass. So I don't waste any time on properties that don't meet my little box. And I know it because I know my Dallas market so well.
So you just hit on one of my favorite topics, which is location. You've got to know your location. And another
Mhm.
aspect you mentioned is you're very specific. You
Mhm.
go specific to get rich and you diversify to maintain wealth. So yeah,
Mhm.
if you wanted diversity, it would protect your wealth, but being specific means you're going to be able to grow your wealth, and really knowing your niche means you don't make mistakes other people do. Other people make
Mhm.
mistakes because they just think they know a little bit about a market, just enough to be dangerous, whereas you actually know the market, you know the blocks, you know what's going on. So you're definitely so I like a lot of these podcasts because it allows me to interview syndicators I'd like to work with. And so far you're hitting all the check boxes of somebody who knows what they're doing, loves what they're doing. And I also was an accountant. I have an accounting background and got into real
Awesome.
estate because of, like you said, those spreadsheets, which
Mhm.
is so important. I think if somebody's going to run a syndication, they have to know the numbers in order for me to trust the numbers. Knowing that you're looking at them, that makes me feel more confident. So Sadia, you've been doing this for a while now. Obviously, you know your market really well. In fact, you live there, which really helps. One of the scariest things for me is when a syndicator doesn't live in a market, right? When they're raising the capital and they're doing stuff, and that's fine. I know a lot of guys do it. They do very well. They know their research. They always have somebody on the ground. But you're living in the city, in the area. You know what was new, what's not new, what's been there, the crimes. I think that's so valuable that you said that it's one of your leverage points.
Mhm.
So Sadia, what do you see happening in the Dallas market? What do you see happening for growth there? And are you still buying in Dallas or considering somewhere else?
Totally. So I've definitely drank the Kool-Aid here. I'm a huge Dallas fan. That's not going to change for the next at least 5 years down the road. I see everyone migrating here. I see job growth, population growth, and every report I read talks about, Dallas is always among your top 10, if not top five, or your top market for multifamily. I see it. I see the highways. I see the new construction. I see how much expansion there is. I see how my traffic is more clogged nowadays than it used to be a year ago, 5 years ago, etc. So,
Facts.
I mean, these are all signs of growth and new companies relocating here. I can't even, keep up with the number of reports and emails I get on a daily basis that talk about companies establishing their headquarters here or moving a major part of their business here. And it's a very diverse set of industries. It's not just committed to, one little sector. It's diversity of jobs is so important, whether it's manufacturing, electronics, government, schools, you name it, they're all moving here. So I just don't see Dallas slowing down. I do see that your knowledge of the market, your knowledge of the properties, it really dictates the price of a property, how well it's been maintained, how well it's been run. So if you're looking at it as a potential investment, passive or active, you have to say, is there really potential or are we overpaying for the property? Because even in an excellent market, you could be overpaying for something. So you got to make sure the deal still has meat left in the bone for you to take it, because you will be paying most likely a higher price for it today than what it was sold for a few years ago. So just one little thing called property taxes can completely bomb a deal in the Texas market, because there are certain counties that go aggressively for your property taxes. So if you closed a deal today, which we're talking November election, post-election day, 2020. So, next year, that county, especially Tarrant County, Denton County, to name a few, they're going to come after you. They want you to pay 100% of your times the property tax rate for your purchase price. So you need to make sure you accounted for that. So that's one of the things I look for when I look at investments is for sure, did they pay property taxes? Did they account for that increase in property taxes? That's just one little tidbit when you're doing business in Texas, right? Because that can completely. Same with insurance. Like, just because you're not in Houston, yeah, Houston's always going to have high insurance because of all the flood damage kind of things, but it's Texas overall. So did you account for the high insurance? Did you make sure you got an actual quote from someone who does business in Texas and is willing to give you insurance for your property address, right? And then the third big one I always look for is you have a local property management company with knowledge of the market who has therefore given you an actual budget for that property, because it's one thing to just assume, oh, I'm going to just operate it the way this person has operated in their T3. But it's different when a property management company who's going to take over the property for you gives you an actual budget, and you look at those rent comps, rent bumps, and say, okay, this is what's realistic for year one. So today in a COVID era, one of the most important things for underwriting is to make sure your rent bumps are ideally zero for the first year, and you can sustain the property, and then maybe a little bit, a small number in year two. And then your other income shouldn't be the primary thing that drives your property. It's nice to have, like whether that's pet income or parking, et cetera, but the other income shouldn't be the reason that your deal, you can make or break your deal. So just so many little things that go into underwriting a property that a novice investor might not be aware of, but it's good to listen to more podcasts and take your own notes, get a couple of really good books, and have the same standard checklist. Whether look at an investment property in, I don't know, Dallas, North Carolina, doesn't matter. The criteria should be about the same. And I have the same discipline when it comes to stock market as well. You look at the same 5 or 6 things, the company really well. You don't just bet on a company because a friend gave you a stock tip today. And you look at, okay, in the next 12 months in this COVID era, what do I expect this company to do? And am I looking at it as long-term or short-term? So again, your goals are very important. I need this to grow by this much, but I'm not expecting this money in the near term. Real estate is definitely long-term. So any real estate investment you go into, don't count on that money being available to you anytime soon. And if they promise you that, that's great, but don't bet on it for the next at least 3 to 5 years, right?
Yeah, I love that. So everything you just said, like you speak so fast. There's so much value in just a minute of your conversation. So for everybody listening, I want you to give this a thumbs up if you're seeing or if she's been valuable. And also what she mentioned is listen to podcasts. You have to listen to this podcast again because she speaks so fast. There's so much content, so much value in there. You're going to miss it if you don't write these things down, if you don't slow it down, go back and listen. So if it's been valuable, give it a thumbs up. It's really important to share that you're getting value so this can rank up and other people can learn from Sandhya and from what the Alchemist Nation podcast is doing here, which is teaching you how to invest in the right syndications, teaching you how to invest in real estate in general. And yes, like Sandhya said, like if you're doing flips right now, I don't think they're big enough to justify, but I think there's so much risk coming in the market that single family homes are going to get wiped out. So it's, unless you can buy like 100 of them at a time or 50 of them at a time, the single family market is something I'm personally avoiding and staying out of. So Sandhya, going back to some of your points about evaluating these deals, I want to know how you raise your capital. Are you raising as a 506B or a 506C or a private placement memorandum? What is your structure that you'd like to raise under?
I tend to do 506Bs. So if anyone wants to invest with me, I have had to have multiple conversations with them, make sure they're really comfortable and they understand the risks involved, because any deal you invest in has a lot of risk and you need to be sophisticated enough to understand the risk. We need to make sure that you're not investing your last 50K of savings in this one deal. That's just a bad idea. You want to make sure you have 6 months of living expenses saved before you even consider investing in any type of securities. So I tend to do 506Bs, so I cannot advertise the heck out of my deals on Facebook, etc. But anyone who likes my philosophies and wants to get to know me more, they can certainly visit my website. We can schedule a call. We can establish a relationship. So maybe in 6 months later, if I have a deal and it meets their criteria, then we can look into it. But I'm not the one where, I just met you today. Great. I'm going to send you my deal over tomorrow. It just doesn't work that way. We take the time to establish a nice substantive relationship to where I want my passive investors to keep coming back. I don't want this to be a one-time, fly by night kind of deal where you invest once and you regret it and then you don't come back to me. So the relationship is more important to me than getting you in on my first deal quickly kind of scenario. So it's mostly 506Bs.
I love that. So Sandhya, I like the 506B. I think it's a good restriction to have to build those relationships. And I think it helps with the investor learn more about what they're doing. I think the Dave Ramsey approach of making sure they have that 6 months in the bank is a requirement for investing. If they don't have the 6 months, it's not time to talk about investing. Yes, have the conversation with us. We can teach you how to save, what kind of requirements are going to be there so you can set goals, because I think goals are important. But and so it's good to reach out to Sandhya anyway. Just even if you don't have the money and it's something you want to do, you want to do it. It may just be that 6 months, a year from now, 2 years from now is when you're going to be doing these things. It's good to set those goals. Having your 6 months reserve, having $50,000 on top of your reserves, where you start investing. If this is not a short-term investment, this is for wealth. This is wealth building, which takes time. It's not an overnight success. So Sandhya, what's the easiest way somebody could contact you if they were interested in learning more about your deals or learning more about how you invest, what the equity portions are? What is the easiest way to contact you? Contact information, website, or email?
Yeah. My website is the easiest way to find me. It's multifamily4u.com, where 4 is the number 4 and YOU. So multifamily4YOU.com. You can put in your name and email address to reach me, or you can scroll down and type a message saying, I want to talk to you about this specific thing, etc. And it's also got recordings of my prior podcast interviews, such as this one. So you can get to know a little bit more about me and see if it's a good fit for you, the way I work.
Awesome. And when you are on her website, make sure that you send a message. Just let her know that you came through Walter Morel, so she can say, man, that guy's podcast brought me a lot of people. It ranks up my social currency with my friends here, so that as they're raising capital, they can say, you know what, next time I do a deal, I want to bring him in and see if we can raise more capital together. Because for me, the more value I add to everybody on this podcast, the more value they're going to give you when it comes to training you guys and teaching you guys. So make sure you add value to Sandhya. At least ask her what she's working on. Find out what deals she's working on. And if you do have capital sitting on the sidelines, cash is trash. Just a reminder, cash is trash. You got to get it invested into something like multifamily. I do think that we're going to see some deflation coming, But at the end of the day, the only thing I want to be holding is a multifamily property, not any other kind of investment, because I think stocks are going to get crushed, crypto's going to get crushed, gold's going to get crushed. Gold's too volatile anyway. As much as I love gold and I have gold and I hold silver, I still think that multifamily market is going to be the strongest investment you can make. Sandhya, if you go back, I got to end this in a few minutes, but if you could go back to 20-year-old Sandhya and give 3 pieces of advice that you think would improve your life now, what would those 3 pieces be?
Consider real estate sooner and diversify instead of being exclusively in the stock market. Consider getting involved with more organizations revolving around real estate, so that you have the network, the connections, and therefore the confidence to get into real estate quickly, because it was something completely unknown to me. And just, I was your typical Asian geek who made good grades and went to work and got a good degree kind of situation. So I was afraid to get into real estate because I knew so little. So the network would be the biggest thing, I would say, and in a different industry than where you are in. So you can learn something new and you can start the second income, third income in parallel, so you can quit your corporate job at a reasonable time.
Very, very good. Very good. And 3 pieces of advice. So network more, quit your job sooner, and what was the other one?
Diversify, basically.
Diversify.
Diversify of whatever it is that your primary job is, so that you have a second plan coming up in parallel. And then you can switch over when that second income stream beats your corporate salary.
I love it. Multiple streams of income, diversify. So Sandhya, you've given so much value. Thank you so much for hanging out with us. Again, if you're interested in investing with Sandhya or learning more about what she's doing, you go to multifamilyforyou.com and learn more about Sandhya and what she's doing. Also, make sure you like, share, and subscribe, because what you do here is going to add more value to everybody else in the world. If people knew more about these powerful investment strategies that allowed them to increase their wealth over time and actually diversify, like Sandhya just said, an extra stream of income, people would do it more often. The problem is people don't know about it. So if you can share this with a friend, a family member, and learn more yourself, have them qualify, say, hey, does this make sense? You're going to learn, they're going to learn, and hopefully we'll make the whole world a better place. Sandhya, you are an alchemist. You have the mindset to turn people into gold. Thank you so much for coming on the podcast. I appreciate you.
Thank you so much for having me. I appreciate you.
Hey, when you have a choice, always work with the best. Cheers to your success. I'll see you later.